You were trading well. The setups were clear. The execution was clean. You trusted your system. You trusted yourself. Then a few losses came. Nothing unusual, nothing catastrophic, just losses. The kind every trader expects, the kind every system produces. But something changed. Not in the market, not in your strategy, in you. Suddenly, the same setups that looked obvious started looking uncertain. The same entries that felt natural started feeling forced. You began second-guessing analysis you would have acted on without hesitation a week ago. You reduced your size. You delayed your entries. You cut winners before they reached your target because something inside you stopped trusting the trade. And the performance that had been building, the consistency you were starting to feel, quietly unraveled. Not because your strategy broke, not because the market changed, because 3 losses rewrote the story you were telling yourself about who you are as a trader. That is not a strategy problem. That is not a system problem. That is the most underestimated force in trading psychology: confidence collapse. And in this video, we are going to examine exactly why it happens, what is driving it at the neurological level, and what the path back looks like, not through winning more, but through understanding what confidence in trading actually is, because most traders have it completely wrong. Let's go deep. Part 1. Confidence is not what most traders think. When traders win, they feel sharp, capable, in sync with the market. When they lose, they feel uncertain, disconnected, like something fundamental has shifted. This feels logical. If you are performing well, confidence should be high. If you are performing poorly, confidence should adjust. But here's the problem with that model. Outcomes in trading are not fully within your control. A perfectly executed trade can lose. A sloppy, undisciplined trade can win. The market does not reward correct process with correct outcomes on every trade. It rewards correct process with positive expectancy over a large sample of trades. And if your confidence is tied to individual outcomes, if it rises with wins and falls with losses, then your confidence is being driven by something you cannot fully control, which means your confidence will always be unstable, which means your execution will always be unstable, which means your results will always be unstable. The entire foundation is built on something that fluctuates by nature. True confidence in trading is not outcome-based. It is process-based. It is the deep, stable belief that you have a defined edge, that you can execute it consistently, and that the results over a large sample of trades will reflect that edge. Process-based confidence does not collapse after 3 losses, because 3 losses do not invalidate a process. They are simply 3 data points within a distribution that was always going to contain losses. The shift from outcome-based confidence to process-based confidence is one of the most important psychological transitions a trader can make. And most traders never make it, because outcome-based confidence feels so natural, so logical, so justified, until it destroys them. Let's go inside the brain, because confidence collapse after losses is not a character weakness. It is a neurological response, and understanding it changes how you address it. When you experience a loss, especially a series of losses, the brain activates a threat response. The amygdala fires, cortisol rises, the nervous system shifts into a state of heightened vigilance. This is the same response we have explored across this series, but in the context of confidence, it has a specific and particularly damaging effect. It activates a phenomenon called behavioral inhibition. Behavioral inhibition is the brain's mechanism for slowing down and becoming more cautious after a negative experience. In evolutionary terms, this was protective. If an action produced a bad outcome, slowing down and becoming more careful reduced the likelihood of repeating the mistake. In trading, behavioral inhibition manifests as hesitation before entries, reduced position sizing, early exits avoided as setups that resemble the one that produced the loss. All of these behaviors feel like prudence, like learning from experience, like responsible risk management, but they are not responses to new information about the market. They are responses to emotional memory. The brain is not saying this setup has a lower probability of success than it did before. It is saying the last time I acted decisively, I experienced pain. I will be more cautious this time to avoid that pain. That distinction is everything. Because the setup has not changed, the probability has not changed. Only the emotional memory has changed. And when emotional memory drives execution decisions, you are no longer trading your system, you are trading your fear. There is also a second neurological layer. The prefrontal cortex, the rational, planning part of the brain, relies on a stable emotional baseline to function at full capacity. Under normal conditions, the prefrontal cortex evaluates setup subjectively, assesses risk accurately, and executes decisions cleanly. But when confidence collapses and the stress response is active, that stable baseline disappears. The prefrontal cortex becomes less decisive, less clear, more susceptible to the emotional signals coming from the amygdala. This is why a trader with shaken confidence can look at a perfect setup and still feel uncertain. The setup is valid, the analysis is correct, but the brain's evaluation system is operating in a compromised state, and a compromised evaluation system produces compromised decisions. Not because the trader lacks skill, because the neurological infrastructure that skill depends on is temporarily impaired. Part 3. The emotional memory of loss. Losses leave psychological residue. This is one of the most important concepts in trading psychology and one of the least discussed. When you close a losing trade, the trade is over financially. The position is gone, the loss is recorded, you move on. But the brain does not move on at the same speed. The emotional memory of that loss remains active. It is stored, and it influences every subsequent decision in ways you are often not consciously aware of. The next time you see a similar setup, something happens. A small voice, a hesitation, a barely perceptible reluctance. What if this one fails too? That voice is not analysis. It is emotional memory speaking, and it changes behavior in ways that are measurable but subtle. You enter later than you normally would. You use a smaller position than the setup warrants. You move your target closer to entry than your system calls for. You exit at the first sign of adverse movement rather than trusting the structure. None of these adjustments feel like fear. They feel like caution, like wisdom, like the appropriate response to a recent losing streak. But what they actually represent is emotional memory contaminating objective execution, and the compounding effect of that contamination is devastating, because each of these small adjustments reduces performance. Reduced performance produces more losses. More losses strengthen the emotional memory. Stronger emotional memory produces more adjustment, and the cycle tightens, until the trader no longer recognizes their own execution, until the system that once produced results is being applied so differently, so hesitantly, so defensively that it cannot possibly perform the way it was designed. The system did not fail, the emotional memory hijacked it. Part 4. The self-doubt cycle. Let's trace the full cycle precisely, because naming it makes it visible, and visible patterns can be interrupted. It begins with a loss. or more commonly, a cluster of losses within a short period. The losses themselves are within the normal distribution of the system. Nothing unusual, nothing indicating the edge has disappeared, just the natural variance that every trading system produces. But the brain does not experience them as statistical variance. It experiences them as failure, and failure triggers self-doubt. Self-doubt creates hesitation. Hesitation produces late entries. Late entries mean poor positioning. Poor positioning increases the likelihood of being stopped out. Being stopped out produces another loss. Another loss deepens the doubt. Deeper doubt creates more hesitation. More hesitation produces worse entries, and the spiral tightens with each rotation. Here is what makes this cycle so difficult to break. At every stage, the behavior feels justified. The hesitation feels like prudence. The reduced size feels like responsible risk management. The early exit feels like protecting capital. The avoidance of certain setups feels like pattern recognition. None of it feels like fear. All of it is, and none of it is responding to the market. All of it is responding to emotional memory. The trader believes the strategy stopped working, but in many cases, the strategy is identical to what it was before the losing streak. The real problem is behavioral drift caused by shaken confidence. The system is fine. The execution of it has collapsed. Part 5. The search for reassurance. When confidence weakens, traders seek reassurance. This is one of the most natural and most destructive responses to a losing streak. You analyze more, you study charts longer, you watch educational content, you seek out traders and analysts who validate your approach. You look for something, anything, that confirms your system is still valid and your losses were just bad luck. And on the surface, this looks like diligence, like the responsible response of a serious trader to a difficult period. But it is not diligence. It is reassurance seeking. And reassurance seeking does not restore confidence. For one fundamental reason, the reassurance being sought is certainty about future outcomes. And certainty about future outcomes does not exist in trading. So the search never ends. Because no amount of analysis, no number of videos watched, no quantity of confirmation from other traders can guarantee that the next trade will work. And without that guarantee, the reassurance is incomplete. So the trader analyzes more, adds more indicators, increases their criteria for entry until the setup has to be perfect before they will act. And a setup that has to be perfect before entry never comes, because no setup is perfect. The result is a trader who is simultaneously overanalyzed and under-executed, who has spent hours preparing and then hesitates at the moment of action, who knows more about their strategy than ever before and trusts it less than they ever have. Confidence does not return through information. It returns through disciplined repetition, through taking the trade when the criteria are met, even when it feels uncertain, especially when it feels uncertain. Part 6. Lessons from professional traders. Some of the clearest insights about confidence come from professionals who have navigated extended losing periods and emerged with their edge intact. One principle observed consistently among experienced traders is this: loss is information about distribution, not information about ability. When a professional experiences a losing streak, their first question is not, "Is my system broken?" Their first question is, "Did I follow the process?" If the answer is yes, if every trade was executed according to the plan, the risk was defined, the stop was honored, then the losing streak is simply the distribution expressing itself. It is variance, and variance is expected. It does not require a response, it requires continuation. Another principle widely shared among professionals who have managed capital through multiple market cycles: Confidence is not built by winning. It is built by trusting the process when winning is not happening. The easy version of confidence is the kind that exists during a winning streak. That confidence costs nothing. It requires no psychological work. It is simply the emotional byproduct of positive outcomes. The valuable version of confidence, the kind that actually determines long-term performance, is the kind that survives a losing streak. That confidence is rare, and it is built not through more analysis or more reassurance, but through the repeated experience of executing the plan correctly regardless of outcome. Through taking the trade when the criteria are met, even when fear says wait. Through honoring the stop, even when hope says hold. Through continuing to execute when results are temporarily poor. Each instance of correct execution during a difficult period is a deposit into the confidence account. Not a large deposit, a small one. But small deposits compound, and over weeks of consistent execution, regardless of results, the confidence account fills. Not because the trader won more, because they proved to themselves through their own behavior that they could be trusted. Part 7. The hidden danger of hesitation. When confidence disappears, the natural response is caution, and caution feels safe. It feels like the responsible, mature response to a difficult period. But in trading, excessive caution carries its own cost, a cost that is rarely discussed. When you skip valid setups because your confidence is shaken, you are not just missing one trade. You are disrupting the sequence that your system depends on to produce results. Trading systems are designed to work over a series of trades. The positive expectancy, the statistical edge, exists across many repetitions of the same setup, not in any single trade. When you skip trades from that sequence, you are removing data points, and removing data points from a probabilistic system distorts the distribution. The winning trades that would have offset the recent losses are not taken. The recovery that the system was designed to produce is prevented by the very caution meant to protect against further damage. And the trader, looking at their results, concludes that the system is not recovering, that the edge is genuinely gone, when in reality, the edge was never applied consistently enough to demonstrate itself. This is the hidden danger of hesitation. It does not just cost you individual trades, it prevents the system from doing what it was built to do, and it creates a distorted picture of performance that deepens the confidence collapse further. The solution is not recklessness. It is not forcing trades or ignoring genuine risk. It is the recognition that skipping valid setups is itself a form of risk, the risk of never allowing your edge to breathe. Let's get concrete. Because understanding why confidence collapses is only useful if it points toward a rebuilding process. And the rebuilding process is not what most traders expect. The first tool is the process audit. After any losing streak, before changing anything about your strategy, conduct a process audit. Go through every losing trade. Ask one question about each. Did I follow the plan? Not did it work? Did I follow the plan? If the answer is yes across the board, entries were taken correctly, risk was defined, stops were honored, then the losing streak is variance. The system is intact. Nothing needs to change. Continuing to execute is the correct response. If the answer is no, if entries were early, stops were moved, size was increased, then the losing streak has a behavioral component, and the correction is behavioral, not strategic. Fix the behavior, not the system. The second tool is the minimum size reset. When confidence is genuinely shaken, reduce position size to the smallest meaningful amount, not to zero, to minimum. This removes the financial pressure that amplifies hesitation. At minimum size, the outcome of each trade carries less emotional weight, and with less emotional weight, execution becomes cleaner. Each clean execution at minimum size is a small deposit into the confidence account. When 10 consecutive trades have been executed correctly, regardless of outcome, size can begin to increase, gradually, one increment at a time, tied to process adherence, not to winning. The third tool is the behavioral journal. During a confidence collapse, shift the focus of your trading journal entirely. Stop recording profit and loss as the primary metric. Start recording process adherence as the primary metric. After every trade, grade yourself from 1 to 10 on execution quality. Did you enter at the right level? Did you honor the stop? Did you follow the plan from entry to exit? When process adherence becomes the measure of success, confidence becomes independent of outcome, and that independence is the foundation of genuine stability. The fourth tool is the distribution reminder. Write this somewhere visible before every session. I am trading trade number X in a series of thousands. This individual trade does not determine my edge. My edge exists across the series. My job today is to execute one trade correctly. That statement, internalized before the session begins, reframes each trade from a high-stakes individual event into a single repetition within a long sequence. And single repetitions within long sequences carry far less emotional weight, which means far less behavioral inhibition, which means far cleaner execution. You did not forget how to trade. Your edge did not disappear. Your system did not break. What happened is simpler and more human than any of those things. A few losses created emotional memory. Emotional memory created hesitation. Hesitation created worse execution. Worse execution created more losses. And the cycle tightened until the gap between who you were trading and who you are as a trader felt insurmountable. But it is not insurmountable, because the problem was never strategic. It was psychological. And psychological problems have psychological solutions. The solution is not a new system. It is not more analysis. It is not waiting until the market feels right again. It is returning to the process, one trade at a time, executed correctly, regardless of outcome, until the proof accumulates, until the behavioral evidence rebuilds what the losses temporarily dismantled, until confidence returns, not as the fragile, outcome-dependent feeling it was before, but as something harder, something earned, something built on the knowledge that you can execute under pressure, that you can follow your plan when fear says don't, that you can trust your process when results are temporarily against you. That confidence is unshakable because it is not built on what the market gave you. It is built on what you refused to let the market take. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video. Until then, control your mind.